Hey there, we're live. It's another freaky, frightful Friday in the market. I think you could take my live stream from last Friday and just overlay it onto today, and it's the same market route that's continuing to take place. It's just, and it is a route. We just finished the month of April. It was the worst month since 2020, worst month for the Nasdaq since 2008 or 2009. So this is a really tough time. The big story of the day, of course, is Amazon, if you haven't heard about it. Anyway, this is my live stream. It's called Be the Boss of Your Money. I usually run through this at 4:30. We're going to do a quick one today on a Friday. Friday is usually not my day to stream. Um, but I always say if there is something crazy going on in the market, then that would get me to come out and do a quick live stream just to give you an update, reassure you, let you know where things are standing, let you know what things could look like next week. And I want to make sure you're not making any hasty decisions, panicking, or whatever. Hopefully, you have a strategy, an investment plan that you could stick with that took into account rough markets. And we've had rough markets before. This is nothing new. I just feel like people, because of cognitive dissonance, I guess, investors forgot what it's like to have a really bad market. And we're having a really bad market. This is not even close to being the worst market that we've ever seen. Okay. We've seen much worse markets. 2000, 2007 to 2009 were way worse than this. Now, this could become like that. I'm not saying that's my prediction. It could go up. So we don't know. That's what we have to acknowledge. And that's why it's going to take an awful lot of personal conviction and optimism to stay invested. So let's just roll a quick intro. Um, let's put up a banner. Let's roll a quick intro. Again, this is just an impromptu show. I was literally about to walk out the door, and I'm like, uh, I really need to reach out to you guys and just give you the skinny and not leave you hanging for the weekend, and you know, do something here reassuring, because this is not the end of the world. This is not the end of the stock market. It was a horrendous day, every bit as bad as it was last Friday, even a little bit worse. So let's roll the quick intro. I'll give you the quick rundown, and then we're all out of here for the weekend. Here we go. All right, thanks for joining me. I'm Mitch Goldberg. This is my live stream called Be the Boss of Your Money. We're doing an unscheduled live stream today on a Friday because the market just got pounded. I stream Monday through Thursday. I have a show about personal finance, investing, and helping you take control of your money. That's why I call the show Be the Boss of Your Money. It's a control thing, and you should be in control thing when it comes to your money. You should be a total freaking control freak. Maybe that should have been the name of the show, Control Freak Friday, Control Freak Money, something like that. Anyway, be the boss of your money. So markets got pounded. Let's take it straight to the tape, okay? Dow down almost 3%. Yeah, that's about as what it did last Friday also. NASDAQ down over 4%. It's a little bit worse. And S&P down 3.6%, a little bit worse. So this is a really horrendous day. This is just a really tough day in the market. Everything went down. What caused it? We're going to get into that. I just have to show you Amazon, but while I have you on the screen, oil went down a little bit. The 10-year yield went back to its cycle high and year high today. So anybody who thought like, oh, yields went down to 277, 228 a couple of days ago in the 10-year, right? On the 10-year, right back up, and it's at the point now nobody wants to touch this thing, and the VIX rocketed up 11%. Okay, back into the 30s. So let's take a look at another screen. Let's look at the culprit. Okay, 52-week low on Amazon. That is not something that you see very often. 52-week low on Amazon. I mean, this is not Robinhood or Teladoc or some other junky yucky stock. This is the king. This is the one that you all want to own and all buy a couple shares for your account. Okay. While you're watching, guys, hit me with a thumbs up, a heart, a celebrate, or whatever the reaction available to you depending on which platform you're watching on. I stream to YouTube, LinkedIn, Facebook, and Twitter, and of course, I always post the snippets, the next day or so. And I also am very active on Instagram, and you can catch me there at InstaMitchG. Got a couple of comments, so let me just take a look who's out there. Okay, Lawrence Rojak. The daily wild swings of the market are like bipolar disorder. Agreed. I feel they represent panic and instability in the investment world. Oh, absolutely. Absolutely. That's what it is. And we've got a high from Jen Veda. Forgive me if I mispronounced it. I've been really lucky. I've gotten a lot of new subscribers on my YouTube channel. So thank you, everyone in YouTube land. I really appreciate that. And Andrew Janisic is also joining us on the sideline over there. Thank you for the thumbs up, buddy. It was nice to see you, Andrew, this morning. Very nice to see you, always. All right, so this is the culprit of the day. Amazon down 400 points or 14%. That's right. It's worse than you think. All day long, we're like, wow, Amazon's going to be down 200 points after the close last night. They missed earnings expectations, growth slowdown, and they didn't give a particularly good forecast going forward over the next few quarters. And stock could be down like $200, $300, down over 400. So Amazon's at a new year low. And the crazy thing is, if you look at the chart, I pulled up a 5-year chart just for you guys. If you look at this, okay, right here around March, let's say March 1st, it was as high as 2,000. But as we got into the pandemic stuff, it popped up. This is right around when the pandemic started, around 2,200, 2,300. The stock Amazon has basically given up. It's almost its entire pandemic gain. It's literally the entire gain from the pandemic is just about gone. Oh boy, this is why it pays to take a little profit. I personally, I like to take profits on stocks that go up a lot. And when they go parabolic, when they go up a lot, like a real lot, a stock could be up a lot in 10 years, but the whole move might only come in a matter of a couple of days. I don't sell. I like to hold on to some for the long term. So but I'm not being specific about Amazon, but I think it's a great company. Analysts have come out to defend the company, but it still is a richly valued company. And I know Amazon has always been richly valued, but part of the rich valuation is attributable to low interest rates. Interest rates are going higher. So if interest rates are higher, it makes the future earnings of a company worth less in today's dollars. Hence, you see tech stocks and richly valued jocks and richly valued stocks in general. It's like a tongue twister. Come down so hard. Yesterday's disaster was Teladoc down 40% in one day. So, if you recall, and we're going to wrap this up in a minute. If you recall, one of the things to avoid when interest rates rise are stocks that are richly valued. But I'm not panicking about it. I've been doing this too long to panic. It's up markets, down markets don't really get me down one way or the other. But what the important thing is that companies that need to raise money, because there's a company has to fund itself, right? They have revenues. Revenues go down to the bottom line after expenses and have money, and they fund their operations. If they can't make enough money to fund their operations, what do? They sell they sell stock to the public. They do secondary offerings. They issue more stock, or they borrow. And a lot of companies don't borrow, they issue stock. And we were in an environment for a couple of years where companies could easily issue stock. That's where we had such a boom in SPACs, and companies like AMC were able to issue more and more stock to the public. Okay. It got carried away with so many new issues and IPOs and SPAC. It got ridiculous. And as usual, the street feasted on it and then overindulged, and to the point where there's too many of them. And so much junk, so much crap out there. So anyway, companies that are dependent on staying in business by selling stock to the public that need to raise money, those are the ones to avoid. Okay, as a category. Okay, that's what I would want to avoid. I can't say that for every single company, but by and large, in this environment where it's impossible to raise money, so if a company can't raise money and they're not making enough money to fund themselves, what happens? They run out of money. They could go out of business. The stock could go down to $1 or less. The company's stock could get delisted, and you're left with a permanent loss. There's a completely different set of risks for people who invest in exchange traded funds and mutual funds and people who invest in individual stocks. And I think when you hear financial advisors talk about how stocks always have come back, they've always recovered, all you have to do is stick to your guns, stand your ground, invest for the long term. Yeah, because financial advisors, typically most financial advisors that I know, are afraid of individual stocks, or their compliance won't let them get into individual stocks, which is kind of weird to me that uh, when adults are treated like children. But that's a story for a whole other time. It's But what happens is some individual stocks don't recover, some do. But if you don't have a lot of individual stocks and some crap out and just go to zero or go very low and never come back, that's enough to make a permanent hole in your portfolio. So that's why individual stock investing is so risky. And I think a market like this demonstrates that, because if you think about it, the Nasdaq is down 25% from its top. The S&P, just off the top of my head, is maybe off 14-15%. Look, 14-15% drop is not unheard of. We have these all the time. It's just that investors got so spoiled over the last year and a half that they can't believe stocks can go down. All those newbie investors, you guys, I'm sorry, I'm not trying to insult you, but the people who are trading in Robinhood, who were calling me personally and saying they should come work with me and I should hire them because they're so good at picking stocks. They just want to sit there and pick stocks and get paid lots of money to do so. It doesn't work like that. And as you can see now, that your ability to pick in stocks was really dependent on the environment you were in, and you capitalized on it, but you probably didn't get out. And that's what happens because people don't walk away from a fun party. All right. As you can see, you have to walk away sometimes. So that is my philosophical thing, whatever you want to call it. Okay. All right. So what do we have? We have supply chain issues, which even if the Fed raises rates, we expect the Fed to raise rates. We've got a Fed meeting next week where we expect the Fed to raise the federal funds rate 50 basis points, which is a nice jump. But yeah, there's inflation and you have to raise rates. The Fed's going to raise rates to combat inflation. But raising rates doesn't take care of shortages because of a war, because of a pandemic, because of supply chain disruption. Rising rates does not help that, but it does create pain. It's the Fed's in a real conundrum is really what happened. Okay. And how it shakes out, really nobody knows. I mean, I think we're pretty much giving up on a short-term resolution to the war in Ukraine. We're pretty much battening down the hatches and expecting this to go on for years and years and years, and that impacts globalization. It impacts inflation, and it impacts the what investors have gotten used to, for the last 40 years. What else is going on? The Fed, inflation, and supply chain disruptions. Well, they all go hand in hand. The Fed could raise rates to tamp down inflation, but part of the reason we have so much inflation is because of supply chain disruptions. You think about Ukraine as like the breadbasket to Europe. A lot of chemicals and elements come out of Russia and Ukraine. Think about the shutdowns that are happening in China because of their COVID policy. So all of these things impact us. Not to mention we have some pretty bad droughts in the West. So there's a lot going on, and I don't blame you for feeling negative. But it doesn't mean you should sell everything you have. This is not that. It means that you have an investment plan. It's not too late, by the way. If you've got a hodgepodge of stuff in your portfolio, just like this stock and that stock you bought, this stock you bought, you just bought a bunch of stocks you thought would be good, but there's no rhyme or reason to what your asset allocation looks like between cash, bonds, and stock, and how much you have in growth stocks, your value stocks, or which sectors you should be in. It's not too late to do that. Don't think that because the market's down that you have to ride what you have back up. Very often, the recovery plays you have, be it individual stocks or funds, they don't have to be the same stocks that you rode down. You are allowed to make adjustments, to make changes, but don't just start trying to run into the next hot thing, because what you're going to do is you're just going to keep stair stepping lower and lower and lower, and it's just a recipe for disaster. All right, that's my take on what's happening. If you have any questions, hit me up in the comments. Even though the live stream is over now, I will see your questions, and I hope to hear from you soon. And that's about it. I wish you a good weekend. We're going to have a lot of interesting stuff to read, and we'll see what things look like next week. But again, May 4th next week, May the 4th be with you, is the day that the Fed will announce their interest rate hike. We'll see what they have to say about future rate hikes. And that should be a very, that has the potential to be a very big market moving event. All right. I'll speak to you soon, guys. Thanks so much.